So today we are going to continue with the three sessions we've been doing. So this is the fifth series. We've done four so far. And the first one, we covered candlestick anatomy. We covered market structure, which we said we have three of them: the bullish market structure, bearish market structure, and the consolidating market structure. We also looked at shift in market structure. That is when the market structure is either shifting from a bullish market to a bearish market. And we also looked at break of structure. And I think we also looked at the institutional reference points, which are the breaker block, mitigation block, fair value gap, liquidity void, the rejection block, and which one did I not call? I think, and the fair value gap. We've covered all of this. So today I'm going to be showing you guys, I'm actually going to be teaching you guys a strategy that you can use based on what I've taught you so far. So the strategy is, I call it OTE. So this strategy is based on where we are going to be using this strategy based on the market structure I told you guys. So because I said there are three major market structures, which is we have the bullish market structure, which is something like this. That's a market that is forming higher highs, higher lows, higher highs, higher lows, indicating that market is continuously breaking structure. And then we have the bearish market structure in the form of lower highs and lower lows like this. And then we have the consolidating market, which is either forming a higher high or lower high. Basically, what it does is we see a ranging market where the market is just accumulating, it's not doing anything. So in markets like this, what you want to do is to not trade it at all. Just stay off the market in situations like this. So OTE, I'm going to be using a bullish market structure to explain what OTE is. So if you've been following, I told you guys that in a bullish market structure like this, is what we call a trading range between this low here and this high here. Is what we call a trading range. Now, as a trader, your responsibility is to trade within this range before the market breaks this structure. So you can actually enter this market by either selling between this high to probably a low here, or you buy it from here and then you allow the market to take out this high. Okay. So you can either sell from here or buy like this. So now basically OTE is a strategy that uses the range as I told you. And how are we going to use it? There are certain tools we are going to be using because this range, we have to know how we're going to enter and we have to be very precise in our entry. Okay. So now I'm going to be giving you guys a tool called we call it Fibonacci retracement tool. So what Fibonacci retracement tool does is it measures the trading range. You see, as I said, it's a trading range between here and here. So I said this low here to this high is a trading range, meaning you're supposed to be trading, you're supposed to either be selling like this or you are going to be buying. But in a bullish scenario like this, what you're expected to do is to be buying. Okay. But as you get better with the market, as you understand the theory is better, you will be able to also sell and still buy here. Okay. So this OTE, this tool here, we call it a Fibonacci retracement tool. How we are going to be using it is I'm going to be defining the Fibonacci retracement tool. So let me just remove it like this. So you see, anytime you are in a bullish market, how you want to use the Fibonacci retracement tool is you're going to be measuring from the low here to the high. If you are in a bearish situation like this, what you're going to be doing is you're going to be measuring from the high to the low. This is very, very important for you to understand. In a bullish market, take note, you are measuring from the low to the high because the market is buying. In a bearish situation where the market is forming lower highs and lower lows, you are going to be measuring from the high to the low. Okay. How do you now use this Fibonacci retracement tool to enter the market? Now, from what you are seeing here, you can see 0, 0.5, and then 1. But in the real sense, what you have is 0, 50, and then 100. Okay. So 0, 50, 100. So what it means is this is the center of the range. This is the center of your trading range. This is 0 and this is 100. Now, the center of this range, we call it equilibrium. Okay, equilibrium, that's what we call it. Then anything that is above 50% is called a premium. Anything that is below is called discount. Let me define it. Here, we call it premium. Here, we call it discount. And then the center, we call it equilibrium. Hope my spelling is correct here. So this is 0, 50, and 1. So this is discount in a situation where I'm measuring from low to up. So this is our discount, right? This is our discount and this is our premium. So now how we are going to apply this in a situation where you want to enter the market is like this. Let me just use a real life example. When you hear the word premium, what normally comes to your mind? Premium, from the word premium, it sounds like something that is expensive. Okay, let's say you go to the market and then you want to buy a mobile phone. Let's assume the normal price, the equilibrium price, that is the price that everybody knows the product to be, is, let's say, 100. Let's say $100. Okay, let's say the price is $100. Now, in a situation where you go to buy the product or this mobile phone, and then they tell you that the product is no longer 100. So let's use example of this. Let's say the equilibrium price, or that is the normal price everybody is used to buying, is 100. Okay. And then you go to the market and then they now tell you that the price of the product is no longer 100, but it's now 150. Automatically, it means that this product is expensive. Okay. It means that the product is now expensive. So at this point, you can say that the product is a premium product because the original price used to be 100, but now it is 150. It means that the value of the product is higher, meaning currently it is at a premium, okay? And then discount when the price of the product is actually lower. So let's just assume 80. So when you hear the word discount, what it means is if you go to buy a product and then they now tell you that, okay, we're going to give you a discount, meaning they're going to sell the product to you at a price that is actually lower. Now, using a real life scenario, if you go to buy a product and then they tell you, okay, the current price of this product is at 80. Now, if you are into buying and selling, what do? You buy when the product is low because you know that the normal price is 100. You buy it, you want to buy when the product is low, when the product is at 80. And then let's assume, as I said, let's assume you are into buying and selling, okay? Let's assume you buy when the product is at 80, and then you now maybe hold the product for some time. And then let's say maybe after some days, let's say after some days, you now hear that this product is now 150. What do you want to do? You want to sell. You want to sell the product because you bought it at the rate of 80 and then you're now selling it. And we know that the actual price of the product that everybody knows is supposed to be 100. So you buy low and then you sell high. So this is what we're going to be doing using the Fibonacci retracement tool. Using our trading range, what you want to do is whenever you see price in your premium area like this, what you want to do is to be selling at least into this 50%. And then when price moves into the 50% or below the 50%, which is what at a discount, what you want to do is you look for buying opportunities. Let me show you another essential part of this Fibonacci retracement tool. How you want to use this tool is like this. In a situation, now given a situation where you are trying to buy, right? So let me use or give you guys an example with a situation where you want to sell. So now this is our fib, you see? So I said if you are trying to sell, you draw it from up, down. And I said this is your trading range. It is very, very important for you guys to, the only way you'll be able to identify a trading range very quickly is by backtesting. So it's not just watching the videos. We people should try and do your own personal study, try and be looking at the trading range, seeing how it's unfolding and all that. Okay. In a situation like this, you see, we are trying to sell. So as I said, this is our premium area, premium, premium, and then this is our discount. So we are selling at premium and then we are buying at discount. But you're not just going to do this randomly. On the levels, there's a level where you're actually supposed to start either buying or selling. So in this situation where you are selling, the Fibonacci has different levels. So in a situation where you are selling, there's a level like this. I don't know if you guys have a pen. This is a very, very crucial part to understand. If you are trying to sell, in a situation where you are trying to sell, you are supposed to draw your feet from up down, right? Now, there are two levels. The first level you are supposed to pay attention to is your 0.5, your 0.62 level. This is the first level. You see this blue line here? That's your first level you're supposed to pay attention to. 0.62. You're supposed to pay attention because price might possibly start reversing from this level. Or if it doesn't reverse from this level, the next level price might want to reverse from is your second level, which is your 0.705. This is the second level that price might potentially reverse from. So it's the same thing for a bullish scenario, a scenario where you're trying to buy. So
Okay,
this is your
I'm sure.
okay. So you see, it is a situation where you're trying to sell. So you draw your feet from your trading range from up, down. This is where you are trying to buy. You draw your feet from down, up. Okay. Now, in a situation where you're trying to buy, what you do is you don't, or you could actually start selling here because it is price is at a premium. Okay. So here, so if you look at it here, this premium, despite the fact that this is bullish, this is a bearish scenario, you see, it still remains the same. You sell at a premium. You see, as you're selling, the price is going down, right? In a situation like this, you are buying and the price is going up. But what I want us to do is let's just focus on following the trend. So in a bullish scenario, what we want to do is let's just focus on buying. So let's not sell here. Let's just look to buy the market here. Okay. So look at this. So the same level that is on the bearish example I'm giving here is the same level on your bullish example here. The first level is 0.62. The second level is 0.705. So if the market doesn't start reversing for a buy on this first level, you wait for the second level and then you enter this market here. Your stop loss is supposed to be this low. So if you are selling here, your stop loss is supposed to be this high here. And then you make this your take profits. Now, um, there are a couple of people that I taught this. I think last year, I taught them this strategy last year. And all they do is they are constantly making money from the market. In a week, they can get like 2 or 3 trades from the market. You get. So, and this is a strategy that doesn't really require too many moving parts. All you need to do is understand your trading range. That's one. First of all, the first thing you need to do is let me just list it out. To be able to use OTE, let me just make it principles of using the OTE strategy. Number one, identify your trend. Number two, you have to identify your trading range. Okay, number three, I've not covered it yet. Identify your institutional reference point within the range. Okay, now if you want to use the OTE, the first thing you need to do is you have to identify the trend of the market. That is the market structure. Is the market structure bullish? Is the market structure bearish? Or if it is consolidating? A consolidating market is a market that we don't really trade. The second thing you need to identify is your trading range. So your trading range in a bullish market is this low to this high. So you are now going to be using your FIP to draw between the low and then the high here. In a bearish scenario, where the market is forming lower highs and lower lows, you want to identify your trading range, which is this high here to this low. And then you could just draw your fib and leave it. And also the time frame, this is very important. You could use 5 minute, 15 minute, but from what I've noticed, OTE works better if you are on the higher time frame. So the best time for using the OTE. So use it on the 1H time frame, use it on the 2H and your 4H. So these are the time frames you're supposed to be drawing out your FIB. Okay. So but first of all, you have to identify your daily range. You have to identify where you are on overall on a daily basis. Let me go on the daily time frame and then let's analyze the charts on a daily time frame. Okay, so this is our daily time frame. This is GBP USD. This is a very, very nice looking trading range. Let's analyze this. Let me go to 2H time frame. All right. Now look at this 2 hour time frame. And if you remember, I said the best time frames for OTE is 1 hour, 2 hour, and 4 hours, right? Now look at now these are 2 hour time frame. So what you need to do is Since we know that our market is bearish, let's identify our trading range. And our trading range is from the high to the low. You see what I told you? All you need to do is just identify your trend, that's market structure. The next thing is you go down to the lower time frame and then identify a very, very obvious trading range. This is a very obvious trading range. You see, high to low. And look at what happened when the market entered this first OTE. So this is your OTE one, optimal trade entry, and this is your OTE two. So this OTE one, if I ask you guys are supposed to be able to know your OTE um, just by seeing it. So OTE one and then this OTE two. So you can see that market did not enter OTE two. It actually entered OTE one. So in situations like this, how you want to just approach it is just look for as the market is forming. Look at you see market is forming from here. Market is buying, and then if you pay attention, you notice that most of the candles here are green. Majority of the candles going up are green, telling you that the market here is bullish. And then all of a sudden, as the market entered the OTE, what happened? Market is starting to show selling momentum here. I almost forgot. The one other principle of using OTE is your OTE is supposed to align with either is supposed to align with one of the institutional reference points. You guys can remember the institutional reference points. We have the order block. And let me just start based on the order of priority. We have the mitigation block, we have the breakout block, we have the liquidity void, we have the fair value gap, and then we have the order block, and then we have the rejection block, hold highs and hold lows. So in a situation like this, if you've been paying attention to or you've seen the previous video especially, you will notice that there is a breaker block here. You notice that there's a breaker block here. That is the last down candle before the move up. So now see it. So even without using your OTE, even without using your feet, you should have noticed that there's a breaker block here. And what makes this a value breaker? You see, market's taking out this high before shifting structure. That's to tell you that market will definitely come back here and look at market only tapped into it and then look at how it reversed. So now the point I'm trying to make is that your OTE is supposed to align with an institutional reference point, either a fair value gap, order block, mitigation block. At least one of these institutional reference points should be aligned with your OTE. So this would have been a very, very good entry. And how you're going to enter this market is like this. I don't want to go down because if I start going down to lower time frame to show you guys entries and all that, I think it's going to defeat the simplicity. But as time goes on, you guys will be able to go down to lower time frames. Okay. But for now, this strategy only requires you to, when the market enters either OTE1 or the OTE2 that is aligned with an institutional reference point, what you need to do is just to get ready to start selling in situations like this. For the safety of it, just your stop loss is supposed to be above this. Just target a 1:2. Some people want to just take this trade and just take their profits on this low. But whenever you see a market like this, the market will most times keep on going down. So I recommend that you just do a 1:2 on this one. So I believe this is very much understood. Let me show you guys another trading range. So as soon as market broke this trading range here, a new trading range was formed. A new trading range was formed. And look at what do you have here? This is a liquidity void. That's to tell you that it is in line with your OTE. So you'd have entered here. This would have been your stop loss. You measure a 1:2. You would have done, see the ratio here, 1:2. So you'd have done a simple 1:2 trade. So you see how simple it is to use the OTE, right? So it's very simple. And you are going to keep on seeing this over and over and over again in the market. Let me show you guys another trading range. As soon as this was taken out, we still got a new trading range. You see, look at your OTE. What do you have? You have a fair value gap here. Let me shift it so that you guys will see. You have a fair value gap here. So just look at it. Trading range aligned, institutional reference points aligned, within the OTE aligned. Now let's try and check a 1:2. Here would have been your stop loss. 1:2, smash. So you see, would have been a very good trade, but do it took time. If you're not patient, because each of these candles you are seeing is a 2-hour candle, okay? But you would have gotten your profit. That's the good thing. I can keep on showing you guys examples and examples and examples. Look at another very nice trading range here. You see between here and here. Look at. I told you guys the market will not just reverse for no reason. If you look at this very carefully, what price traded into is an order block. You see an order block here. Even though it passed your OTE1 and your OTE2, at the end of the day, if you had used here this high as your protected, your stop loss, you would have been good. You would have been protected. And this trade gave, you see, this trade gave, you see, we're able to get our 1/2. So I can just keep on showing you guys examples and examples and examples because this thing works. It works. In a week, you'll be able to see like 3 or 4 setups. Let me just be conservative. If I say 4, it's almost like trading every day. But let's just assume you are trading multiple pairs. Let's say you are trading like 4 or 5 pairs. You could just be looking out for this. It might not appear on a pair today, it might appear on one. So in a week, you should be able to get like 3 or 4. 3 or 4 is okay if you are trading multiple pairs. So OTE is a strategy that you can use to consistently make money from the market. I told you guys, if you really want to enjoy trading, you have to make it simple. Less is more when it comes to trading. You don't have to do so many things. You don't have to be up and down in these markets. You get all you need to do is just have a strategy that works and that can allow you to be patient. Because this is a strategy that if you guys want, you can fund and then start making money. Because I said the rule of using OTEs is first of all, you have to know the trend. Are you bullish? Are you bearish? On the daily time frame, I showed you guys that we are bearish. You guys saw it. Then right now, I've been identifying trading range up and down. You get so the next thing you have to identify institutional reference point that is in line with your OTE1 or your OTE2, and then make sure you use the high in a as your stop loss in a situation where you are trying to sell. First of all, you also have to identify your premium and your discount area. The reason why we are selling here is because it is at a premium. We are selling where the market is expensive, or some people will say that it is overbought, so you have to start selling it.